The CEO of Nvidia, the largest AI company on the planet, just said that the AI bubble that everybody keeps talking about doesn't exist. Here's what Jensen Huang said, quote, "There's been a lot of talk about an AI bubble, but from our vantage point, Nvidia, we see something very different." Now, the reason why I'm making this video is because very recently I published a video from Michael Burry's perspective on the AI bubble. Again, Michael Burry is the guy that shorted the housing market leading up to the 2008 crash, and then he made a fortune. And then there was a movie made about him called The Big Short. Well, Michael Burry recently published a big short position against Nvidia and Palantir because he says that there's a big AI bubble that's about to pop. Now, obviously, we have very different opinions. Michael Burry says this AI bubble is about to pop. The CEO of Nvidia, the largest company in the United States, says, no, we don't see an AI bubble. So let me break this down, because the reason why a lot of people keep saying AI isn't a bubble is because they're referencing the dot-com bubble that we saw burst between the years 2000 and 2002. During that time, what we saw is a lot of money was flowing into internet stocks. A lot of people were hoping for these huge big gains, so there's a lot of speculation. And then when money started to tighten up, people realized, oh, a lot of these internet companies with these multi-million dollar valuations, hundreds of million dollar valuations, not only don't have any revenue, but they don't have a plan to make any money. And then the Federal Reserve Bank also started raising interest rates, which made money more tight. And that's what ultimately burst the dot-com bubble. Here we are today, and we're seeing some similarities, but also some differences. The similarities is, number one, there's a huge amount of money going into AI. Everywhere you look, companies are pouring money into AI. The government's putting money into AI. Foreign governments are putting money into AI. So we're seeing a lot of money go into artificial intelligence. There's a lot of speculation for growth, just like the dot-com bubble, because people are expecting and hoping for huge gains, huge returns. But there's a couple differences. The companies, especially the large ones in the AI space right now, don't just have revenues, they also have profits. That didn't exist during the dot-com bubble. That's the first key difference. The other key difference is right now, we're not seeing interest rates rise, we're seeing interest rates go down. This is one very big difference, because generally, higher interest rates pop bubbles because they make borrowing money more expensive and they make money tighter. And when you make borrowing money more expensive, investors have to be more picky on where they invest their money. So they don't want to put their money into speculative investments as interest rates go up. Right now, the Federal Reserve Bank has been cutting interest rates, and they're probably going to keep cutting interest rates in 2026 because President Trump wants aggressively lower interest rates. So if that happens, that could actually make the bubble bigger, because generally lower interest rates lead to more spending, more investments, because, well, investors get to borrow money cheaper, so they can be a little bit more speculative. That's generally what happens. Not saying that's what always happens, but generally that's what happens. Now, obviously, Michael Burry and Jensen Huang have their own biases and their own incentives, which you should understand. Now, as a reminder, if you are an investor or want to become an investor, I have my free investing masterclass where I walk you through how you can get started investing and how you can find hidden investment opportunities before everybody else. I'm also going to lay out the exact framework that my firm and I use to research investment opportunities before they hit the headlines. All you have to do is register, it's free, and as a bonus, you're also going to get access to market briefs, which is my newsletter for investors, as a complimentary bonus. So if you want to get the investing masterclass and market briefs all for free, all you have to do is register, and I have the link for you down in the description below. So let's talk about their biases, because the CEO of Nvidia knows that Nvidia makes money if people keep buying their AI chips. Well, if people are scared about a bubble, two things happen. Number one, spending might slow down. And if spending slows down, people might buy less chips from Nvidia. Not to mention, number two, if people are scared about an AI bubble, less people might want to invest in the Nvidia stock. And at the end of the day, the price of any asset, whether it's the Nvidia stock, whether it's gold, whether it's a house, whether it's your phone, the price of anything depends on supply and demand. When you have more buyers than sellers, the price of that thing generally goes up. When you have more sellers than buyers, the price of the thing generally goes down, and that's especially true in the stock market. So for the CEO of Nvidia, he wants people to, number one, buy his chips, and number two, buy his stock, because that helps the stock value go up, and that helps the company make bigger profits. From Michael Burry's perspective, you bet he also has an incentive. because Michael Burry shorted Nvidia. He shorted Palantir. He shorted these AI stocks. And the way shorting works is you make money when a stock goes down. So if he can instill fear, maybe he can pop the bubble himself. And if he can instill that fear and people start to sell that stock, he makes money. And so Michael Burry has an incentive to see that stock goes down. Jensen Huang has an incentive to see that stock go up. That's why you have to understand the incentives behind what people say, because at the end of the day, Jensen Huang wants to keep seeing the money move. But we have to go a little bit deeper into what's going on. And I should also mention that Michael Burry, after he disclosed his short position, he got a lot of interesting feedback. Some people really hated the idea. Some people loved the idea. But ultimately, he ended up closing down his hedge fund after his short position was disclosed. We don't know exactly why he closed that hedge fund, but now that he closed it, we're not going to know if and when he actually gets out of his short position. But let's go a little bit deeper into how AI can actually impact our economy, because there's a lot of parts that I think people overlook, because a lot of times we think AI and we think, oh, people's jobs are being replaced. Well, there's a lot of different impacts to our economy, like inflation. For example, if AI can reduce labor costs, there's a consequence to that. People lose their jobs. But they can also lead to deflationary prices. Why? Because if a company can produce a product at a lower price, they can sell it at a lower price. Now, a lot of times you might say, oh, Jaspreet, when companies have the ability to lower their price, they're never going to do that. Well, that's not exactly true. We've seen the prices of technology actually fall over the years. If you remember how expensive TVs used to be 15 years ago, well, TVs have become cheaper. Why? Because the cost to produce them have become cheaper. As long as you have competition, that will help keep the prices of things stable. Now, it's not always the case, but yes, if you have competition and you can reduce the cost of producing, you can see the price of the item go down. The other thing that can make things deflationary with AI is productivity gains. Because if companies now can be more productive with AI, that's the ultimate goal, that one person can now do 10 people's jobs because they have AI, that can also reduce the cost that businesses have, which can also be potentially deflationary. But there's also inflationary costs with AI as well. Number one, if there are chip supply shortages, that could lead to inflationary issues. What do I mean by that? All the technologies, all the electronics, all the semiconductors nowadays need chips. These chips require certain metals. You may have heard about rare earth metals. Well, if there's a shortage of any supply of these chips, that can make it hard to produce these electronics. It can make it hard to produce these semiconductors, which make it hard to produce pretty much every product, from cars to dishwashers to defense products. And right now, we know that there's a big geopolitical tension between the United States and China. The reason why this matters is because China is the leading producer of rare earth metals. These rare earth metals aren't actually rare in the earth. It's just that China is the world's producer and refiner of these rare earth metals. And because of the tariffs that have been put onto China, China is now restricting the exporting of those rare earth metals to the United States. Now, yes, the United States is trying to build their own supply chain and trying to produce their own rare earth metals, but we're not there yet. So is there a chance that we could see some chip supply shortages? Who knows? But if that happens, that could cause more inflationary issues, because if we can't produce those products, that could cause the prices of those things to go up. The other thing that could be inflationary in the world of AI is the amount of spending in AI. Because when you have this huge sum of money going into AI, it makes the prices of things to go up because you have all this money going into AI. And right now, we don't just have private companies investing in AI, we also have the United States government investing in AI. We also have governments around the world pouring billions of dollars into artificial intelligence, which of course can make things more expensive. So you want to understand that side of AI because it can impact the economy in many different ways. And this is where I want to tell you a couple things that you need to be aware of. Number one, AI is not going away. Are we in a bubble? Probably. We're always in some sort of bubble. Like, you got to understand that that's just a part of the economy. Bubbles happen. Recessions happen. They've always happened. They're going to continue to happen. The key isn't to worry about there being a bubble. The key is to understand how can you find the investment opportunity. And that doesn't necessarily mean you wait for the bubble to burst. It means you're just understanding where's the economy moving. Because AI is not going away, period. AI is going to change our economy. It's changing our economy faster than the internet did. It's changing our economy faster than social media did. It's changing our economy faster than really anything we've ever seen. And the people that understand this are going to be able to ride the next wave of wealth. The people that don't are going to fall behind. And this could be in your investments. This could be with your job. This could be with your business. So you want to understand what's going on with AI. But because this is a finance channel, and because that's what I understand, I want to go over different ways that you can understand the AI investment. Now, I'm not telling you what to invest in because number one, investing is risky. And number two, I'm just a random guy on YouTube. I'm not a financial advisor. I can't tell what to invest in. I can't tell you what to invest in. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So number one is the infrastructure layer of AI. This would be things like cloud computing and semiconductors. This is the top layer of AI. And this is what most people think about when they think of AI investing, which can it be an investment opportunity? Absolutely, but this is what everybody thinks about when they think AI investing. But as an investor, I want you to think about your investments like an onion. And what that means is a lot of times we focus on the outer layer of the onion, but you got to go deeper, and that can also help you find those better investment opportunities. So everybody knows the outer layer. That's the chips, the semiconductors, that's the cloud computing. Those are the major companies that everybody sees, but that's not the only part of AI. If we take it one layer deeper in this onion, we can think about automation. That's the robotics side of AI. That's the cybersecurity part of AI. That's the enterprise AI tools that companies are using inside of their companies. This is now one layer deeper, but it creates another investment opportunity because if people are pouring their life story, their business story, their business's finances, their personal private documents into ChatGPT, Claude, Gemini, whatever, you bet that now cybersecurity becomes incredibly important because hackers want that information. ChatGPT doesn't want it to be hacked. So you bet that there's a lot of money going into cybersecurity because of what's going on with AI. Then we could take it one layer deeper in this onion. Every time you go into ChatGPT and you enter in a query, you enter in anything, a prompt, that information gets stored in the cloud. Now the cloud isn't in the sky. It is in a physical building called a data center. Now there's been a lot of shifts and money going into data centers. Companies are talking about putting data centers on the moon. The Trump administration is now working to sell off some federal public land to build data centers there. But there's a lot of money going into data centers, and that can also create a potential investment opportunity. There are businesses that are involved in building data centers. There are businesses involved in operating the data centers. There's businesses involved that are owning the data centers. All of those can be individual investment opportunities as well. But again, we could take it one layer deeper in the onion. These data centers and these AI companies require a lot of energy. Technology is now requiring more and more energy to operate. Well, this creates investment opportunities as well. How do I know? Because the Trump administration is putting a lot of money into this energy. We want to become more energy independent here in the United States. We want to rely less on foreign energy. And one of the things we're also doing is we're shifting what type of energy we want to rely on. The Trump administration is taking money away from green energy, putting it more into fossil fuel energy. The Trump administration is very actively pursuing nuclear energy. And these data centers also require a lot of energy. There are companies that specialize in providing energy to data centers. Could that provide an investment opportunity? Maybe, depending on what your investing goals are. This is why I want you to start thinking like an investor and understand how there are different layers of investments to the same industry. But we can still take it one more layer deeper in this onion. Because inside of a data center, you have all these chips that are working very hard to store memory. And these chips can get very hot. You know, like if you're using your iPhone or computer a lot, it can start to heat up. Well, imagine now you have a whole building full of these chips that are actively working. Well, this can get very hot in the building. And if that facility overheats, everything can malfunction. And if that happens, it would be a disaster for companies and our economy. Data center facilities cannot afford for that to happen. It would be disastrous. So they invest a lot of money into cooling technologies. This is, again, another investment opportunity, potentially. There are startup companies that are working to provide cooling technologies for data centers specifically. Some are very innovative, providing new and unique ways to cool this down at potentially cheaper prices, because you got to imagine that it's expensive to cool all these data centers. So there's a lot of competition on who's going to be the winner to actually cool the majority of data centers here in the United States. But this is how I want you to think. A lot of people are worried about there being a bubble. Is there a bubble? Probably. If the bubble pops, is that going to create more investment opportunities? You bet. Market crashes create more millionaires than any other time. Instead of fearing them, embrace them. But besides that, also understand how the economy is shifting. When the dot-com bubble bursted in 2000, the internet did not go away. Although people thought that the internet was going to fail, it did not go away. People use the internet more now than ever before. Now here we are, the same thing with AI. A lot of people are saying once the AI bubble bursts, AI is going to be done because AI is so stupid. It can't actually do the jobs that humans are doing. AI cannot actually replace people. Some companies fire whole departments and then realize, oh no, we actually need humans. Yeah, we're going through those growing pains, but AI is not going away. It is going to make work more efficient. Companies that actually invest the time and energy and resources to use AI are going to find ways to be more productive. And the biggest risk is not AI taking your job right now. It's somebody taking your job who understands AI better than you. Yes, it can create investment opportunities. Yes, there's probably a bubble. Yes, you're going to see volatility. Understand all that. But from a business perspective and from a career perspective, you have to understand what's going on with AI. I've talked about this so many times now, but I run a company called Briefs Finance. We used to be called Briefs Media. We had to make a whole 180 pivot because we went from a media company realizing that, oh my God, AI could make us bankrupt in just a few years. If we don't switch, we're gonna all lose our jobs. To now becoming a fintech company powered by media. We're building a whole new AI software which has data and a bunch of investing tools. The most powerful investing tool in AI that I've ever seen. Yes, obviously I'm biased because I'm the CEO of the company, but it's something that we're going to be launching in 2026. But the reason why I'm telling you this is because it's happening in many, many, many industries. And I'm seeing it happen. I'm going through it right now. So I'm teaching you what I'm learning, because if we didn't make this pivot, it would probably be very bad for our company. And a lot of people are hesitant to wanting to adopt AI. Just understand, look, this shift is happening. It's going to continue happening. I would rather you learn. That way you can find the opportunity instead of being the person that gets blindsided. And if you don't know what you need to learn, go into ChatGPT, go into Claude, and ask it what you should learn. Tell it about yourself. Tell it what you do. Tell it about your job. Tell it about your business. Tell it about your investments, and ask, what should I learn? That way I can be more productive and see better returns than what I do, and you might be surprised at what you see. So we have Jensen Huang, the CEO of Nvidia, saying we're not concerned about an AI bubble. We don't see the AI bubble. We have Michael Burry saying there's definitely AI bubble. I'm shorting these stocks. Now, Michael Burry has obviously closed down his hedge fund, so we don't know exactly what he's doing with his money, but there's two perspectives out there. Every person is going to have their own incentive. My incentive is for you to learn what's happening. That way you can make better decisions with your money. Of course, I have my free investing masterclass for you down in the description, but I want you to understand how the economy is shifting more than anything else. That way you can find the opportunity. That way you can build your wealth no matter what's happening, whether markets are going up, down, or sideways. Again, if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education.